All right. I am super excited for my guest today on the Investor Podcast. I've got Loren Remetta. Loren Remetta is the CIO at Bowbridge. Bowbridge is a corporate credit and special situations investment company focused on asymmetric, value driven, and stressed investments across public and private markets. So it's going to be really interesting to kind of talk through that intersection. A lot of times there's a little bit of transcendence between, investing in the private markets and then also possibly, crossing over, right? They call that crossover funds. But it'd be really interesting to kind of think through this strategy and how it's, becoming more and more of a blurred line between private and public markets. I mean, sometimes public markets act like private markets and, they're essentially a global long, short credit derivatives approach to structured credit. Previously, before that, a long celebrated history, 24 years in global corporate credit investing and hedge fund management. Product expertise spans across structured credit, credit default swaps, corporate bonds, and private markets. And he's demonstrated a robust track record in portfolio management, spearheading new initiatives, and obviously extensive and impactful global business development networking. So, Loren, thank you for coming on the show. Excited to kind of go deep on all things asset management.
Super, Joel. Thank you. That was a great intro, and it's a unique time within credit markets, and there's a lot of discussion and press on private credit and what the ramifications are there. And I look forward to touching on a bit of all of that and how that's impacting more vanilla markets and some of the interesting things that we're seeing on the deal specific side as well at this point in time.
Absolutely. But why don't we back up a little bit, Loren, and just go back to your early days? Tell me about the young Loren, the formative years. What was going on in your mind through high school, right? And, tell me a little more about your upbringing, your influences in life, kind of what your parents did and how that shaped you kind of getting into your first foray into financial markets and asset management. And then obviously we'll talk about all the things that you built over the years too.
Sure. I grew up in Pittsburgh, PA, which spawned quite a few successful hedge fund managers. Actually, my high school now borders the Tepper School of Management at Carnegie Mellon. But the Tepper School wasn't there. I lived a long time before that. But I grew up in the south side of Pittsburgh, a pretty blue collar neighborhood, and the city at the time, as I was growing up, was going through a transformation with a lot of creative destruction, if you will, with the steel industry declining. But at the same time, there had some great universities that were endowed by the early entrepreneurs and venture capitalists of that day, with the Mellons and the Frick family and so on and so forth. So as that moved on, and the focus in Pittsburgh really transitioned from industry to more technology and medical technology, and that's really benefited it to this time and where we are today. What was I thinking when I was going through high school? Probably not a lot. I thought I was going to go into medical school at one point, and my high school was located right in the center, right between Carnegie Mellon and the University of Pittsburgh. And I was actually an intern in high school in the genetics lab at the University of Pittsburgh, and we were doing gel electrophoresis, forensic genetic maps of pedigree horses. And I was also a high school hockey player and ended up going to Penn State to play hockey. And that's when I started to get a little more interested in the business side and declared it as an econ major in my sophomore year there. And from there, it led to my internship in my junior year was with Credit Suisse First Boston in their London office. And I did not know much about Credit Suisse. They didn't have a Pittsburgh branch at the time. And came back from there and graduated in 2000, which was a pretty good time to come out of school. Fortunately, had multiple job offers and ended up with my first position, which, you come to forks in roads. Sometimes you come to T's in roads, and accidentally really fell into the credit derivative market at a unique time, really at the early stages. And my first position was in the back office doing P&L calculations and trade reconciliation for credit derivative and structured products.
Mm-hmm. What years was this? Was this during kind of the
2000, 2001.
Okay, got it. So it was a couple of years before actually the whole, CDO,
yes,
situation that happened in 2007, 2008.
Yeah, that's the company that I started with was a bond insurance company called AMDAC,
sure.
And they were doing bond insurance while I was there. All the insurance that they were doing were on corporate CDOs that were AA, single A, or AAA rated with they were rated AAA. They went out and offered an insurance policy on the CDO, which took the rating up and reduced the spread and gave the buyer the insurance rep, gave them comfort, and that worked really well.
Okay.
And then at some point, after I moved on, I was only there for about a year and change. They decided to start doing this with subprime mortgages, and the spread between the alleged AAA subprime mortgage was about 6 to 7% to the corporate AAA CDO tranche.
Mm-hmm.
And that some lights should have gone off at that point, but it didn't. And they eventually filed for bankruptcy and were restructured. But there are a lot of parallels that people are trying to draw to what's going on in private credit now and what went on in the GFC. And I think that's pretty misguided.
Sure.
What we have now is nowhere even close to what went on during the global financial crisis. It's it's not even a fraction. So
yeah,
but that was the early part of my career, and then that I started trading credit derivatives at two German Landesbanks and as a proprietary trader, and I did that for 3 to 4 years, and got hired as a market maker at Bank of America in New York after that. And our job was really to build their credit derivative business, because they were one of the later banks coming to the product, where the market leaders were JP Morgan, Deutsche Bank, Lehman, and Morgan Stanley, pretty much. And a lot of the other banks hadn't taken to the product for whatever reason. Strategically, they weren't committing balance sheet to it. But that's how I switched from the buy side to the sell side, and that was I think an important switch, because I was in my early 20s, so it was I was one of the youngest guys in the proprietary side. Most of the guys were in their late 30s, early 40s, but those guys before were on the sell side. Typically, go to the sell side to the buy side. I went from the buy side to the sell side at that point, so it was a little bit different. But I think it helped as a sell side trader, as a market maker, having the buy side experience, because you understood exactly what was kind of going on in the opposite side of the business. Most guys are sell side guys that typically weren't at the buy side beforehand. Yeah.
So for the audience, I think it'd be helpful to understand that delineation, right? So when I think of the sell side, I think you're JP Morgan or your Goldman, and you're selling blocks of securities. And then obviously the way that you make revenue is obviously on the spread, plus, probably trading fees. And I would say in private equity, if you have an exit, you're going to either transfer those shares with a transfer agent, and then there's a fee that gets charged, or you can just liquidate those shares, right? And both of those, there's convenience fees and handling fees and commissions that happen. So in my mind, that's kind of the sell side. Walk us through, the role of a market maker, and how that incremental role plays in kind of the ecosystem and within your organization as well.
Sure. So I was at Bank of America in New York for about a year and a half, and then I got transferred to London, and I was there for about 3 years.
Sure.
And we were making markets in various credit derivative products. And just to keep it simple, a credit derivative is essentially bankruptcy insurance on a company. And as the market evolved and developed, it started as a hedging instrument for bank lending portfolios. And banks had large exposures to General Electric, General Motors, and Ford. So they created a way to hedge this.
Yeah.
And then it quickly moved up the curve, and there's probably a few hundred names after 3 or 4 years that were traded. And so to enable those trades to happen, it's an over-the-counter market. And I was the auto sector trader and the credit index trader.
Sure.
And there's typically not always a buyer and seller, so it's not like a stock where it's very quickly traded. Thousands of shares are going through in seconds. You try in a non-risk situation where you have the buyer and seller lined up. That's great. The two salespeople get tremendous economics on that.
Sure.
And in those days, in the early days, it could be almost 100 or 50 plus basis point bid ask on a GM trade.
Yeah.
And as the market matures, now it's probably 5 basis points or maybe 3.
Sure.
So, and trading is a bit more electronic, but the credit derivative market is an area that hasn't advanced that much compared to other markets. It could be ripe for it, but it's harder to do due to the bilateral nature of execution. But your customers are the proprietary bank investment desks pretty much went away after the global financial crisis with the Volcker Rule. And that was a very large portion of our flow, where bank prop desks, pretty much every mid to large size bank, particularly in Europe, mostly large size banks here in the US, had derivative proprietary businesses.
Sure.
And so that was a large portion of our business. Then you have the insurance companies, traditional asset managers, and hedge funds. And as a market maker, you set a price when you're asked to. Sometimes you know which direction, either a buyer or a seller of the credit default swap. And when you get fortunate, you get both sides. Often, more often than not, you're taking risk. So you have to price it. You have a view that it's just not a vanilla price without a bias. And as you're trying to figure out how you want to be positioned, you work with your research analysts. You do your own research.
Yeah.
You really have to have a view on the company that you're transacting in, but also you have to have a view on the market, where you think market prices are going to go. You might think it's a really bad company and the price of insurance should go higher, but if the macro trend overwhelms the company, you could be wrong for a bit before you're vindicated. So it had a lot of proprietary elements as a prop trader, but you had flow. So you had sales forces all around the United States, all over the world, that particularly for autos, which was one of the most active segments of the market. So you had Chicago, New York, Los Angeles, Dallas, London, Paris were your main flow centers. And you're just moving back and forth and trying to manage your book, manage your risk, and combine that with the view of how you want to be positioned. And the hardest part is, as a market maker, is keeping your best positions.
Yeah. Well, you're essentially sitting on both sides, right? You're essentially monitoring the bid price and the ask price at the same time, right?
Yes.
Yeah.
Yeah. The hardest thing is keeping your best positions and not allowing your customers to position you.
Got it. Yeah. And I mean, there's also counterparty risk as well, right? So how do you kind of manage that and kind of mitigate that? I guess there's probably some programmatic technologies to kind of help as well, right?
That manages more of the counterparty risk.
Yeah.
But during the GFC, There wasn't, now there's central clearing, so it's better managed and less risky.
Sure.
But during the GFC, the counterparty risk was meaningful. My book had one of the largest short positions embedded in it for Lehman Brothers, so it made a lot of money when Lehman defaulted.
Yeah.
But I also had one of the largest positions in the bank for Morgan Stanley. So if Morgan Stanley had gone, my book would be in flames.
Yeah, it's funny. I was cracking up the other day because I saw something in my feed. It showed how investment banks really are versus how they really are on these theatrical TV shows, right? And when you talk about London, I think about the show industry, right? Because in industry, they're like, "Oh, the whole market is tanking." You got to talk to the risk department. The whole market is a bloodbath, and then they show like a clip of like what really happens in an investment bank, and it's like a banker sitting in a laptop, and he's like, "Oh, the Excel that one cell in my model like was off by a decimal, so let me correct the decimal," right? So I don't know what your reaction is to that, but just I don't know if you crack up ever seeing kind of the theatrics on like the TV shows, like Billions and Industry. I think it's a good show to watch for someone that's trying to get into the industry and just get an idea for the different personas and different roles that work at an investment bank, right? I mean, you're working in, there's wealth management, there's the product teams that are kind of offering different products on the sell side, and then there's sales and trading, right? So I think just understanding the different personas and just kind of a high level overview of like, what it might be like is interesting. But I've heard from so many people, we've had several hedge fund managers come on our YouTube channel. They're like, "Yeah, man, it's nothing like that at our shop in Connecticut."
I would say that that the first part of my career was in the banks, and the second half is in the hedge fund world.
Yeah.
And what the one input to your trading and your market making is the rhythm of the floor on the sell side.
Yeah.
And particularly when I was in New York and the fixed income floor, there's probably 70 to 80 people in various products all across fixed income. And sometimes it's quiet, sometimes it's manic. Sometimes pizza comes at 7 a.m. On a Wednesday. So there's a culture to it. And when the rhythm of the floor shifts, typically something in the market has dictated that.
Sure.
And your own rhythm within your, kind of sounds strange hearing someone say that, but your rhythm with your screens, with your pricing, with your sales force, that interaction and that, I guess, some sort of market self-awareness that kicks off, and that shift in volume, there's a gust that goes across the floor, the activity is going to pick up and it's going to be pretty busy for a period until that calms down. Shift that to the buy side, to the hedge fund side, it is so quiet at a hedge fund. The people communicate to each other in a chat room. They're 10 feet away. I wouldn't say it seems to be more cerebral on the hedge fund side, but you don't have that edge as a sell side trader does with the everything that goes on around you matters a lot more on the sell side than the buy side.
Sure.
And through divisions, I've only been in the sales and trading part of it, but going to the different floors, it feels like a different world.
Yeah.
And it has a different culture. In the early days, everyone in banking was largely in suits and ties. Very rarely in sales and trading would anyone have suits and ties. I don't think you'd have pizza at 7 a.m. on a Wednesday on the investment banking floor.
Sure.
When there at certain trading floors you worked at, they'd have a beer cart that would come around at 4 o'clock on a Friday. So those things are different, and all that varies by bank too, and each bank has their own nuances and subcultures, shall we say.
Well, let's talk about the next step. And, you labeled this as a turning point. So working at PVE Capital in 2009, joining as a portfolio manager, right? Talk us through that experience. It sounds like you had a key role there essentially diversifying its business lines, right? Leading, the recognition, and, becoming a partner into 2015. Tell me some of the biggest learnings in that experience. And then obviously later on, you managed Pearl Vega Fund, which was a long short corporate credit fund. So walk me through kind of that experience and that. What made that a turning point?
The global financial crisis kind of
2009. Yeah.
pushed me in that direction.
Sure.
And I spent less than a year at UBS before joining PVE. And I did not know a lot about hedge funds and how a hedge fund operates and all the work that is required to run one successfully. But I did know that I had to get out of the banking system because it was going to take a very long time for it to get back to its high water mark, shall we say, if it even did. And the elements of trading pre-GFC versus post, it will never go back to that. Probably shouldn't either, but it just felt like in time to move into a different section of the business. And PVE was founded by my business partner, Giorno Pucci, and he was one of my largest customers at Bank of America. So that's how the relationship began. And we started talking about working together on something when he was at his prior fund before founding that business. And they started, they were supposed to start with around 100 million and started with about 50. And that's when I said, well, that seems a little risky at that number. Why don't, I'm going to go to UBS for about a year and wait and see how the AUM develops. And coming in there, going back to the buy side after not being there for 6 or 7 years. But it was a different part of the buy side. Being on the buy side in an investment bank where you have access to other information, you're still in their ecosystem. You still respond to the same shareholders and the same ownership. With a hedge fund, you respond to your investors, but you're not. You're almost on an island, and that's good. That can be good in ways. And if you look at the pod shops like a Millennium, how they operate, they keep their groups very segregated by design. But at a small boutique credit fund, you're only as good as the information that you can acquire through the broker dealers, through the investment banks.
Sure.
And so your money management investment process has to change. And being a trader versus an investor, that's one of the biggest adjustments from the sell side to the buy side, where on the sell side, you're kind of an investor, you're more of a trader.
Yeah.
At a hedge fund, you're far more of an information gatherer. And your positions are only the positions that you want. You're not as a flow trader, your positions, you have to take a lot of those positions, even though you don't want them.
Sure.
And that process takes a while, that adjustment. And some people don't make the adjustment. And, they move on to something else within a year or 18 months. So my advice to anyone who's going from the sell side to the buy side is to progress slowly. Even though the hedge fund probably wants you to deploy capital as quickly as possible, but that new process, and you're going to transfer a lot of what you've already done, but there's 30 to 40% adjustment that's going to have to happen, and that'll take time. That's not an overnight. That's learned. It's not something that it's innate.
Yeah, no, that's helpful. What do you think are the skills of a successful portfolio manager? And, we've had a couple PMs come on. We've had some people that have worked at some large franchises and then later started their own hedge fund. And the biggest issue they had was just really finding the edge, right? And they ended up kind of pivoting and doing something else. But what do you think are the characteristics of a good PM? And then I think as a PM, you want to build that team of, either sell side or buy side research analysts So how can you build a culture and find the right talent to kind of support you as you're executing with that portfolio strategy?
The risk management, and people talk about it a lot, but there's
Hmm.
a lot of different ways to look at risk management.
Yeah.
And an important part of that is many people are also focused on the downside, which is important, but
Hmm.
there's also upside risk management. And one thing that I think more people are guilty of, particularly myself, is positions that are doing well, staying in them for longer than you might feel comfortable in.
Hmm.
And it's easy to cutting losses. That sometimes that's predetermined. Sometimes the risk manager does that for you.
Sure.
But that is, I think, one of the arts that separates the goods from the greats is when the trend, when you have the right position, you have the right thesis, one, the sizing of the position, and that the sizing is so critical.
Sure.
And two, the duration, where do you cut it 10, 20, 30% too soon?
Hmm.
And focusing on not making money every day, but when you're highly convicted, being well positioned and having the right size it really makes the difference. And that's where I think a lot of alpha gets generated, really through sizing and when to deploy leverage. And that's a whole different discussion with when you're trading with borrowed money, and whether it's through margin or through contract leverage, being able to manage that and manage that well. And then the other major thing is, in the fund side, you have a monthly P&L that goes to your investors. In the investment banks, there's monthly, there's quarterly, but you really get paid at the end of the year.
Sure.
But if you have a drawdown that's significant at the hedge fund, you're going to get shut, or your investor could redeem. So managing on a very incremental basis, but maintaining a longer term trend view or macro view, particularly in macro credit, that's really where the art is.
Sure.
And that's something that takes a while to get adjusted to.
Yeah. What were some of the biggest learnings that you could take away from your time at PVE Capital? And then it looks like you just kind of advanced at, Pearl Vega Funds Prosperize, Capital. It looks like that was part of PVE Capital as well.
Yes.
But maybe just a couple high level nuggets from, that firm, and then walk me through kind of the transition to Breen Asset Management.
Sure. I think the value, investor relationships
Mm-hmm.
and connectivity and transparency are extremely important.
Sure.
And it makes sense, theoretically and at a high level, but to do that effectively, and even when you're not doing well, when you want to hide under your desk, that's typically when you should be communicating the most.
Yeah.
And I'm explaining what the position is, why it's not doing well, what the risk management process is, what's the timing of when you think the position is going to come back, or the
Sure.
book's going to come back, and being able to explain that is 90% of the battle. And sometimes you'll see investors that will actually put more money in at that point if the thesis is clear.
Sure. They just want to double down, pretty much.
Yeah, they think, okay, this is clean, and you say you can clearly articulate how much more downside there is. And there's two types of volatility.
Mm-hmm.
There's volatility that is explained and part of the investment thesis, and then there's volatility that you can't explain and it's not part of the investment thesis.
Sure.
And go into it saying, okay, we have another 5 to 7% risk to the downside here, but we're still 30+% to the upside. And some of the derivatives, structured products can become illiquid. So a lot of that volatility can become just marking from the broker dealer where you're getting marks in, not actual trades that happen.
Mm-hmm.
So it's monitoring that and being able to articulate that to your investors and your stakeholders.
Yeah, that's really helpful.
And
Yeah, go ahead.
No, and then moving up. So Breen Asset Management was an interesting, very interesting place. It was more of a multifamily office that it was an affiliate of Breen Capital, and we were investing in credit markets, private markets, and that's where I got my introduction to independent sponsor investing, and getting to appreciate the value of having synergistic businesses that didn't overlap and at times hedged one another as different revenue flows, as market interest. We were coming out of a period of extremely low interest rates, and credit volatility was very low, and that's when it transitioned into the single deal investing. But the nice thing about that was a lot of the family office relationships that I had from the credit fund side were moving in that direction as well.
Sure. Into just single private direct investing?
Yes, independent sponsored, value investing, distressed growth.
Mm-hmm.
So it was.
So was it it sounds like it was a combination of both public and private.
Exactly. It was a public and private markets business that was developed.
Sure.
And that was, what did that take? It took a group of very talented investors, but also with commensurate deep networks.
Sure.
And being able to transition between the markets is not simple. And deal access is critical for that. And having the relationships and the networks, whether it's on the investor side, the corporate side, and then being able to bring that all together with a capital markets orientation and potentially forming your syndicate of investors to execute the transaction. And that's where, as you said earlier, the lines tend to blur between public and private. Those businesses where you had a position in, say, in the aviation sector, and you're working on something in the aviation sector, having that information, that added information edge, could be potentially valuable. And then as you went through COVID and where we are today, if you look at how Apollo is structured, if you look at how Ares is structured, they're public and private investment companies. So the world has definitely moved that heavily in that direction, and private credit is I think the lever that has taken it there quite aggressively, where you have Apollo, JP Morgan, Bank of America, all on a deal together. And that was a very foreign concept 10 years ago. So that the sources of capital and the ability to structure a deal has become, I guess, easier in many ways, because you have, in the old days when you're a corporate, you went to your bank and got a price on a loan, and that was that. Now, we're working on a transaction at Bowbridge right now, and one of the potential investors said that they, invest with regular private equity funds, they invest with independent sponsor groups like ourselves, they invest with family offices, and they invest with other if they have a fund of funds business.
Sure.
That's a pretty dynamic repertoire to be able to.
It's a pretty big, multi-asset strategy platform.
Yes. And
many of the family offices. So I'm assuming, that firm, essentially they were structured as a multifamily office, right?
It was an RIA, but it was largely investing for a handful of families.
Got it. Yeah. So usually with the RIA structure or multifamily office structure, they have to probably offer a suite of different products and offerings, because that way they can catch all different type of family profiles, right? Some of the families, maybe the family business, they were entrepreneurs and then they kind of got into the private equity space. And then there's probably a hedge fund family, right? So if they can offer like some of those public and private market products, they can service more clients and then probably have, manage more AUM. So do you think that's kind of the case now, with a lot of these other platforms spinning out? It's like, hey, you want managers? We got a fund to fund, strategy. If you want direct deals, hey, we do distress, we do credit, and then we also do venture and private equity as well, right? So do you think it's beneficial to have a bigger suite to kind of get more clients and get more AUM, or do you think it's better to kind of have a niche and just kind of go all in on a certain, focus area?
I'd say I'm in the middle of it, where it's contextual.
Yeah.
And I've been in businesses where we're very strong in a niche and moved away from that, and it didn't work out very well. But I've also seen it where you have a niche and you go into another business line and it works pretty well.
Sure.
And that it has an important stabilizing effect. And then I look at what we're building at Bowbridge, having an independent sponsors business and having the credit fund. There's crossover elements between them with investors, but at the same time, as an emerging business, an emerging manager, maybe the credit fund isn't interesting, and we find there's a specific deal that we're doing that's very interesting. So having the ability to cross between and produce an opportunity that just staying in one silo you wouldn't be able to do, even though you get asked to look at this opportunity and you say, oh, that's not what we do, you miss out. So if you're smaller in size, you have the ability to do that. I think if you're larger in size, you also have that. But if you're in the in-between spot, that's where it can get risky with your brand and being cognizant of that, where you don't want to, the big term is style drift. And whether that's in a fund where, one day an investor wakes up and there's a lot of equity activity going on in a credit fund. So you have style drift there. And then you can have style drift at a more macro level between private equity or credit or private credit or private equity. And the LPs are typically being more understanding of that because it's helping potentially them with a more stable, larger business that they're a part of. But some will question how much of your time is being devoted to this new business line versus managing their money in funding. So I think communication is important, and having the requisite team in place to satisfy those questions is part of it's an art. But if the communication lines are there, the bigger players in the earlier years was harder to do, but now that how Apollo, KKR areas are all structured, or Blackstone, we're not saying smaller businesses can do that easily, but it's more normal.
Yeah. What was the, and I love that this is a great foray into getting into Bowbridge. Tell me a little bit about the origin story of, why you built Bowbridge. What was the inspiration? And it looks like, a lot of managers build something based on their industry expertise, and you have a combination of both the buy side and the sell side, and kind of sitting between public and private markets, and specifically special situations, right? When I think about special situations, I think of, spinoffs, bankruptcies, restructuring, recapitalizations, buybacks, even activist investor situations. So how do you, when you think about the portfolio construction, because once you go through the origin story, how would you advise like an emerging manager kind of getting into this strategy to balance the public and private markets? And, is there a point where they kind of converge into each other?
For us, the credit fund we're building it's 100% public markets. It's very credit derivative focused. structured products. So there's not a lot of overlap. And in the independent sponsor side, these are deals that come to us from relationships that we've had for 10, 15, 20 years. And it's not a business that we're out there actively seeking deals. It's very organic how opportunities come, and we probably look at 10 deals in 1 year, maybe get to an advanced diligence on one.
Mm-hmm.
A lot of time commitment to an underwriting, and especially if it's an area where, depending on the structure of the company and whether it's audited or not, and where it is in its lifetime, how many years have they been operations. Typically we're middle market with 20 million or EBITDA or less, so there's very specific criteria here for
it. Yeah. And when you say a deal and you're thinking about the kind of the transaction, when it's public, you're saying it's already a public company and then they're kind of just spinning off or doing an M&A.
No, not on the sponsor side. That's all private companies.
Yeah, that's all private. Yeah.
Yes, but on the public side, that we're looking at index related products and large cap, high yield issuers.
Sure.
So it's a pretty well defined market, and they're very independent in where they sit and how they operate. The credit funds it's quarterly liquidity, where private side's typically 5 years, 5-year lockup.
Sure.
And but the investor bases can cross over, which is important. And that's where the value, the network, building a new, this is the third time that I've been involved in building a boutique investment business, and the network that's your IP, that is your weight. And being in front of the right people at the right time and being able to be introduced to the right investors, that's not an easy process. And it takes multiple years. And would I recommend it? I don't know, possibly, but you have to have the very precise ingredients in place. And even when you have the right framework and the right thesis, it's tricky. It's still tricky to get the execution and the initial dollars.
Sure. And a lot of times it's, you don't do it for the money in the beginning, right? You're doing it because you want to build something, and you want to build something enduring, because you see in the beginning, there's a lot of startup costs, right? To build a firm. So what advice would you have to give to maybe people that have been working in the industry for 4 to 5 years, even 10 years, and like, look, I want to build something. What should they be kind of going through in their head when they're kind of going through this type of endeavor?
I would, the first is to make sure you have 24 months to really dedicate to it. And then if you can answer yes to that, then you got to look at that day one capital, and do you have 10 to 15 potential relationships that could do it? Not saying they would, but do you have that many? Or do you have 2 that you have, think that there's a 70+% probability that they would do it?
Yeah.
And those are pre-sounding conversations you have, and book building exercises. But if you don't have that sort of visibility in that time, I think it's going to be quite tricky. And then don't, where you see a lot of mistakes made is that if we build it, they will come. And guys taking down a 10,000 square foot floor plate in Midtown and putting all the systems in, and without any capital. And eventually your burn rate's going to eat you alive. So
Sure.
you have to manage that as well. And what's your expected burn rate, and what is it? Is this a solo endeavor? How many people are going to work with you on the project? Is there a creative way to do it where you go out and sell a portion of the business to begin with? And that's not an easy thing to do, but it's a way to raise working capital.
Yeah, when you say sell a portion of the business, are you talking about GP stakes? So giving up some of the, yeah. I mean, look, there's pros and cons with that, right? I mean, there's a couple fund managers that I've spoken to that have actually successfully raised GP stakes capital, and it's a trade-off, right? I mean, you can either save, all of the business and own 100% of the business, but you haven't closed the fund yet, or you give a portion away of the business so that you can just get to work. And we had a couple GP stakes investors come on the pod as well. And, essentially what they're saying is, look, it's a great business. As a fund manager, it's also a great business for large family offices that want to just generate revenue from the GP stakes. But, essentially the main utility is let the managers do what they do best. They're good at deploying capital, managing money, and generating returns. And that way they're not on the road for 18 months trying to kind of raise assets. They can kind of get a lot of that taken care of and then just kind of go and deploy. Right. And I think that's, those are the perspectives that I've heard. I mean, it's a trade-off, right? Because you're giving up some of the business. But, I guess what's kind of your reaction to that in terms of kind of the trade-off for that?
I always look at it if, typically the smaller the percentage of your business that you own, the more successful typically you're becoming.
Yeah.
And the early stage GP investing that's out there and available, it's uneven. And the very early stuff is, I guess there's investor GPs, GPLP, and then there's just pure GPs, investors. And the pure GP side, and that's obviously a far riskier proposition for everyone. But the GPLP side, I think it's a fantastic business. And having gone through this a few times, I think it's actually one of the excess return you can get depending on strategy. But if you're looking to do something in a credit strategy, your excess return can be 400 to 700 basis points a year, depending on the growth of the business. If you have a 20% stake in a revenue share, it doesn't even have to be a GP. Most deals are revenue shares. That, like, most guys don't want to come into your GP for various reasons, which you can understand.
Sure.
But the rev share business, I actually think that's going to see a swing back up. From a macro point of view, if you look at alternatives at a high level, private equity has had problems with realization. Private credit is, I think the headline problems are greater than what's actually happening, but the perception becomes reality and becomes reinforcing. And with all the redemptions, so those were, private equity was a darling around COVID, coming out of COVID. Private equity became the darling, and hedge funds, had inflows, but not meaningfully. Through that experience in PC and PE, you've come to appreciate what quarterly or monthly liquidity can mean. And the ability to deploy capital outside the multi-strats, out of the big household names, it's very limited. And particularly for mid-sized family offices who don't have the sophistication, and I think call it like fund to funds 3.0, I feel that business is going to have a pretty good run through this year into next year, as alternative flows move more into hedge funds with the macro backdrop that we have. There's a lot of dispersion across asset classes. There's a ton of dispersion within credit. We haven't even touched on that, where looking at the software SaaS exposure between private credit, leverage loans, and the high yield market, one is at 20-ish%, the other's in the mid-teens, and the other is below 5%. And that's what's caused wide differences in valuation, and where leverage loans are the widest they've ever been to high yield right now. So that's pretty unusual, outside of a recession. But the things that you want to do with a hedge fund and why you invest in hedge funds, you have normal interest rates, you have more normal volatility. Credit spreads are, depending on where you look, some places they're very cheap, other places they're have some value to them. You want to articulate those types of cross asset strategies benefits the small, medium-sized hedge fund players.
Sure. That's helpful. Well, hey, Loren, I really appreciate all your time. I always like to wrap up every podcast with just one piece of advice. Could be from a mentor, could be from one of your past bosses, it could be from a family member. So what do you got for us?
One investor, we were sitting in the summer sun one afternoon together, and he said, he had just retired. And I said to him, what's really the key here? And he's done extremely well. And he said, keeping the mistakes small.
Sure.
And, that can apply to a lot of things. More than your trading book. And, I think that's important.
Sure. Well, thank you for all the wisdom, Loren. It was great, just learning about your background and all the things you've been building, and congrats on all the success.
Oh, Joel, thank you very much.
All right. Take care. Thank you, everybody else. Appreciate it. Have a great day.
Bye-bye.